Hello, my name is Dale Brethauer. I have over 35 years experience as a professional stock trading investor. These quick lessons will teach you a myriad of trading that I've learned during my journey to success. I not only am a hedge fund manager, I've been a guest speaker at a number of platforms, written 3 financial books, and I'm currently the founder of what I believe is the very best educational website available today. That is www.optionsinfinity.com. These lessons are not particularly applied to my 3 principal trading strategy, but as general knowledge. I hope you find them interesting and educational. The lesson for this video is entitled Options Basics. Basically, an option is the right, not the obligation, to buy at a specific price on or before a specific date. In this example, let's say you're driving through the country and you see some beautiful farmland, and you decide that you would like to purchase this land, and you find out it's the owner is asking $1 million. So what you do is you talk to the owner and you say, I would like to put on an option to buy this for $1 million on or before 6 months from now. So the land is on the market for $1 million. You settle with the owner on an option to buy the land in 6 months for that $1 million. What you want to do for that right is you're going to pay the farmer right now $50,000 for him to hold that option available to you for 6 months. If you don't exercise that option, the owner gets to keep the $50,000. That, in a sense, is the basis of what an option is. Now, going over to the stock market, an option is the right, not the obligation, to buy or sell a stock, ETF, or index at a specific price on or before a specific date. If you think the market is going to go up, you want to buy a call. If you think the market is going to go down, you want to buy a put. One option contract has 100 shares. So if you buy one for $11.30, you have to take that times 100. So that option contract would cost you $1,130. Now let's look at an example on October 8th, 2018. McDonald's was trading for $166 per share. What you do is you go out and buy a McDonald's 18 January 160 call at 11:30. Now, this isn't what that's called in the money option because the stock is already at 166. You're getting an option that is 160, so it already has some value to it. Okay, and it's now October 8th. You're going out to 18 January. You're going out about 102 days for that option. You're going to pay $11.30. Now let's take a look at it. The option that you paid for is $160. It's currently at $167.80. So an option has 2 values. One is intrinsic, and that is if it is in the money, how much is it in the money? So in this particular example, you bought a 160 call. The stock is already at 167.8. So it has intrinsic value of $7.80. Now, the premium on the option is $11.30. The rest of that is what is called time value or extrinsic value, and that would be $3.50. That $3.50 will erode over time. It's called theta decay. And you can say it's very rapid decay as you get within 30 days towards expiration of that option. Remember, the option expired on 18 January. So the closer it gets to 18 January, this intrinsic value will get closer and closer to zero. At expiration, it will be zero. Okay, so let's take a look at what might happen. Here's our current state. The stock is at 167.80. We bought the January 160 call for $11.30. We had an intrinsic value of 780, time value of 350. Okay. Now, first of all, what I want to point out is that you can't lose more than what you paid for the option. So you can never lose more than that $11.30 per share or $1,130 per contract. Let's fast forward 1 month later and say the McDonald's is up 10%. It went from 167.80 to 184.58. Intrinsic value now is the difference between 184.58 and 160, or $24.58. Now, you've gone to 1 month later, so you've lost about $1 in time value. So the net result is you've got, you add these two together, get 27.08. The original purchase was 11.30. You've made 15.78, or 140% on that option. Now, what happens if it goes down? Remember, this is a call option. We're looking for it to go up. It goes down. It goes down to 151. You no longer have any value at all. There is no intrinsic value. It is zero. Similar to what we had over here, the time value has eroded from 350 down to 250. That's what you have left, 250. You purchased it for 11.30. You're down $8.80, or minus 78%. And remember, if it goes all the way to expiration, this becomes zero. The maximum you can lose is at $11.30. Okay, so if you understand intrinsic value and time value, those are the two major components of an option. Now, there are in the money, at the money, and out of the money options. In the money options means that you are, if you got it at 160, that means it is above 160. At the money is right at, very close to 160. In the money has both intrinsic and time value. At the money will have no intrinsic value, but a lot of time value. And out of the money only has time value, because it has no value if it's below, at or below 160. And our example is on October 8th, 2018, McDonald's was trading for $167.80 per share. So let's look at these strike prices. And you got this one right here for 160. So it is in the money. You actually paid, you actually paid 160 for it, and the value of the shares is 167.80. Okay, so at the money is going to be right around 165. Once between 165, 170. That's at the money, and anything below here, or basically above the price, is out of the money. It has no value at all other than time value. In the money, at the money, out of the money. There are different strategies that use different in the money, at the money, and out of the money options. When we do a lot of credit spreads, what we're doing is we are usually selling out of the money options that only have time value. And what we're looking for is the erosion of that time value by theta decay, like we saw on the earlier chart. Now, this is a screenshot showing what's called an option chain. And basically what it is you have the prices for all the call options on the left and the prices for all the put options on the right. And you'll notice, remember the price was 167 per share. That is at the money right here. These are at the money, okay? And anything in the white is out of the money. These only have intrinsic value. Whoops, excuse me, I hit the button premature. These are in the money, okay? So you're sitting at a 167.70. Well, if you have the 190, you've got $22 and some odd change, and the value is 28.33. So the rest is time value. Okay, it's just the opposite on the call side. These are out of the money here, and the ones that are shaded are in the money. This is how you look at an option chain to determine what is the price for which strike price you want to get. This is all the different strike prices you can get. Now let me talk a little bit about the leverage you can get using options. Let's say you buy 100 shares of McDonald's at this 167.80. Okay, what you have to do is you have to buy $16,780 worth of McDonald's shares. A little bit more than a month later, it does go to 190. So now your value of your 100 shares is 190 times 100, or $19,000. You invested 16,780. This is a 13% gain, which is a really, really nice gain in not quite 2 months. Let's take a look at an at the money call. An at the money call. Remember, an at the money call is going to have very little time value, but a lot of intrinsic value. We're going to buy an at the money 18 January 160 call for that $11.30, or $1,130 per contract. Okay. The option on this date is 29.70. So 29.70 times 100 shares in a contract means that this is now worth 29.70. This is 163% of what you originally purchased. That shows you the leverage of options. Now, let me go back here for a second. This leverage can work against you, so you have to be careful. You have to be careful. What I hope I explained here is what's the definition of an option, what is a call option, what is a put option, how you determine its value on the strike price, looking at intrinsic value and time value, and then looking at the leverage of options. Now, what I'd like to do is go over to my website and just show you how you can become a member of Options Infinity. And what we do is we specialize in credit spreads. We look at Forex. We look at One of the biggest things we look at is hedging our portfolio. What I want you to do is when you come over to the website, you can scroll down here. You can click on this button right here to either view or download my 3 principal method for trading. This is a blueprint. It's a PDF file of how I trade credit spreads using options. Then what I'd like you to do is, if you like that, to go ahead and scroll down and become a member. As a member, what you're going to do is you're going to learn all the strategies as I talk to you personally every week in our weekly Tuesday afternoon meetup where all the community gets together. I usually have a lesson. We talk about our current positions, what I see in the future, how we're going to manage them, and then we have plenty of time to answer questions. That's once a week on Tuesday afternoon. If you can't make it, no problem. This is recorded. The other thing is, this is like you're looking over my shoulder and watching me trade. Every time I see a trade I want to make, either a credit spread in options, either a stock trade or a Forex trade or a hedge, I'm going to send out a text or email alert directly to you. So you're going to be able to earn while you learn. I just want to bring to everybody's attention that during this rapid drop in the market because of the coronavirus, a lot of my members were saved from the rapid decay of their portfolios by me sending out an alert for them to purchase a protective put. Protective put will then, as the market goes down, it will go up and the portfolio goes down, but the put goes up. So you have a net, very close to a net zero. It's a wonderful way of protecting your hard-earned money. I also teach how to protect the current option portfolio that you might have. So I'm just basically like the Allstate commercial. As a member of Options Infinity, you are in good hands. I hope you take advantage of this. I'm going to show there's going to be a subscribe button. If you'd like to subscribe to my YouTube channel, you can click on the button, and also I've loaded up another of my quick lessons that you might be interested in reviewing. And ultimately, I hope I see you in the room, and I will talk to you later. Bye-bye now.